I'm Jeff Thoma, Chair of the Central Coast Economic Forecast. We're so glad you could join us for part 2 of our virtual series titled Economy in Focus. First and foremost, we want to extend our well wishes and hopes that you and your loved ones are staying healthy and your businesses remain steady and strong. As business leaders and owners, each of us has had personal understanding of how COVID-19 has impacted our business and industry sectors, but we haven't had the opportunity to look at the economic impact on our county as a whole until now. Today, we'll hear from Chris Thornberg about the current state of our economy here in San Luis Obispo County and how we've fared compared to our neighboring counties. This level of local economic data is only available through the Central Coast Economic Forecast. We're very excited to share it with you this morning. Quickly, before we get started, I'd like to thank CCEF's Board of Directors. There is a lot of effort that goes into planning these series of events, and I'd like to acknowledge the board's active participation. I'd also like to sincerely thank all of our sponsors for your ongoing support of the forecast, especially this year at a time when it's sorely needed. In particular, I'd like to offer special recognition to our 5 platinum sponsors: Amazon, AMF Media Group, Bank of America, Cal Poly Technology Park, and KSBY. We couldn't produce this series without your support. Thank you. Finally, I'd like to take a moment to introduce today's MC, Ryan Caldwell. Unfortunately, Bob Wacker this morning, and Ryan graciously agreed to step in. We're grateful that he could lend his time and talents to today's program. Many of you may recognize Ryan. You know him as the CEO of Wacker Wealth Partners, a current board member and former board chair of the San Luis Obispo Chamber of Commerce, and founding board member and treasurer for the Hourglass Project, now known as REACH. However, lesser known, you may also recognize him from the 2019 annual Chamber Dinner Karaoke Duet, where he performed alongside our famed Bob Wacker. Please welcome a gentleman for which no tune is out of reach, Ryan Caldwell.
Well, thank you, Jeff. I'm glad to hear that Bob and I made a memorable impression on you that night. Good morning, everyone. I am honored to stand in for Bob Wacker today as your MC. I know he regrets being unable to join us today, having to sit this one out, but I do believe he's watching live, so I am trusting that Chris will still deliver plenty of jabs at the Giants. It just wouldn't be the economic forecast without him, so keep them coming, Chris. But before we get there, I do want to cover a few housekeeping items with you all this morning. The first is that, perhaps this is not necessary since we're all experts at this by now, but I do want to mention that today we are broadcasting over Zoom webinar. This is different than Zoom meetings, that place where we spend so much of our day in that we can't see or hear you, and your fellow participants can't see or hear you. And so I want to encourage you to find the silver lining in that and perhaps get a little bit more comfortable, put on those cozy pants, take your shoes off. The way I see it is if you are listening to today's broadcast, you have certainly earned the right to relax a little bit. If you're listening to an economic presentation in the middle of a pandemic with wildfires raging all around, I think you deserve a bit of a break. So get comfortable. But I do want to mention that even though we can't see or hear you, we still want to interact with you. We have reserved time at the end of today's presentation to take your questions and to pepper Chris with the information that you really want to know. And so take advantage of that. During the program, feel free to go down to the chat button at the bottom of your Zoom window and enter in questions. We'll be receiving those throughout the program, and we'll have some time to ask Chris your questions at the end. I also want to make you aware that we're recording today's presentation, and a link is going to be provided to you within about a week's time so that you can share this valuable material with your colleagues, your friends, your clients. And then the last thing I want to say is that if you need to use the restroom during the presentation, there's one located in front of me, on the left, on the right. I'm sure there are restrooms behind me. What can I say? I miss the Expo Center, folks. I do miss it. As Jeff mentioned, today's program is actually the second installment of 3 virtual presentations that make up the 2020 Central Coast Economic Forecast. The first presentation focused on COVID's impact on the national economy. If you missed it, you're going to want to head over to centralcoasteconomicforecast.com and check out the replay. Very insightful, still relevant. You're not going to want to miss that content either. But today's program is going to focus in on the local impact. And this is where the rubber hits the road for most of us, right? If you lead a business here or live here or hire here or invest here, then this data is critical to good decision making, especially during a time of severe uncertainty. And of course, all of this valuable analysis is going to be shared with us today by none other than Dr. Chris Thornberg himself. Now, I know that Chris doesn't really need an introduction to this group, but for those of you new to the forecast, perhaps, I do nationally respected economist. He is the founding principal of Beacon Economics. And since he was here last, in July, Chris has released a new outlook for the US economy that might shock some of you. It's actually quite rosier than most economists. He's also had an opportunity to weigh in with state and national media about the upcoming presidential election and how it'll affect the economy, or how it perhaps won't affect the economy. But we're going to save that for our main event on November 18th. I hope your calendars are marked for that. Today is all about SLO County. So without further ado, I will turn it over to Dr. Chris Thornberg.
Off and running. Wonderful. Again, part two of the presentation, and as noted, a lot more focus on the local economy at this point in time, but not all on the local economy. We do have to, of course, remember that ultimately the local economy is driven by the national economy. And to really understand local trends, we have to talk a little bit about the nation overall. So what I'm going to do is give you a brief update of where the U.S. is and where things are heading. And then we're going to dive into California, dive into San Luis Obispo, and talk about some of the nuts and bolts of what's happening in the local economy. Now, I would tell you to remember that from a local economy's perspective, a lot of the best data is a little bit lagged. So we're still going to be unpeeling pieces of this as we move forward. But let's dive right into the meat of things. Obviously, we're in the midst of the pandemic recession. We have second quarter numbers. Overall, the data suggests about a 11% decline in real GDP from the last quarter of last year to the second quarter of this year. And of course, we all can remember that when this thing first began, unemployment dropped up to really the highest levels in the post-World War II area. As has been noted, the big debate among economists has been U versus V. As we mentioned last time, we're very much in the V camp. Now, why? Well, we went through a series of questions last time I was with you and said, look, this is not a traditional recession, and the traditional rules that sort of dictate what business cycles look like simply aren't applicable here. Now, remember, U is the overall kind of big picture. Last time I showed you this as well. This is the CBO picture of things, where they're talking about a fairly nasty downturn, but really a full recovery that takes nearly 7 years. That's very much like we saw during the Great Recession, which is not appropriate. This is not a Great Recession type scenario. The depth of the Great Recession was driven by the fact the Great Recession was driven by the collapse of the massive subprime bubble that had preceded it. There was no bubble this time. There is no permanent restructuring of the economy that's going to make this a painful recovery. Now, we said that right from the get-go. It's a V, very simple. The economy is resilient. It's in good shape. It can withstand even a large shock because of the fact that the resiliencies are there. And of course, when we were talking about this, we were hopeful that the cases of new cases had largely stabilized. And I think last time I was with you, we talked about the end of the year being a potential time of full recovery. June came, and of course, as again, we talked about this last time, the bounce in the economic activity had already begun. The U forecasters who really were suggesting more job losses, I think the consensus was that unemployment was going to go to 19%. Well, as it turns out, unemployment fell, jobs came up, consumer spending started to bounce, and the U folks were set into a mad scramble trying to explain what's going on. But of course, since the last time I talked to you and this time, something else has happened, because in June, there was basically looked to be an increase in the number of new cases. Lo and behold, that was the real deal, and a second surge has hit. Now, what's interesting is we came to July, and it really was a good news, bad news. The good news was this, and I'm going to get back to this in just a second. For those of you who probably haven't heard, given that every time you pick up a paper or watch the news, you keep talking about the dismal economic situation and how bad the economy is. Well, to be clear, the economy is already out of the recession. Recessions are data peak to trough. The peak of economic activity to the trough, the bottom of economic activity. The peak here was February. The trough, by the way, was April. The recession's over. We're already deeply in recovery. And even more importantly, when you think about what the government does in terms of stimulus, there's a phenomenal amount of dry powder out there ready to supercharge recovery once we get full control over the virus. But with that in mind, of course, July was also the month when we saw a real bump up in the number of new cases in the United States. And of course, that second surge, of course, it pushed back the overall data recovery that we were looking for really in the middle of next year. Got into August, and we updated our forecast yet again about the silver linings to the second surge. You know, there's a lot of folks talking about the slowing recovery. A lot of folks talking about how the August job numbers weren't all that good. Well, let's keep something in mind. The first time we had a surge in the number of cases of COVID, you saw the U.S. number of payroll jobs in the U.S. decline by 20 million. We had a larger second surge this summer, and all you can say is it slowed the recovery down a bit. The reaction to the presence of the virus is so much different now than it was even a few months ago. And yet again, it suggests we can continue to get quickly back on the road to almost full recovery, even without a vaccine. There's a lot of positive news out there. Positive news you're just not hearing from. So let's go ahead and, like I said, we're going to start national and quickly boil down to the local economy. Let's catch up on where we are right now. 33% decline in growth. And their 32, I guess, was revised down by about a percentage point, which isn't all that much. Of course, overall in the second quarter of the year, get worst quarter ever in the history of the United States, mainly driven by consumer spending. Now, when it comes to consumer spending, about a third of consumer spending losses was in healthcare. That's spending delayed, not spending canceled. Most healthcare is paid for by insurance, and procedures that would have been done in the second quarter will be done in the second half of the year. But the other places, food accommodations, recreation services, other services, these are the kind of sectors that still really were the centerpiece of this. You could think of convention centers and theme parks. You could think of, obviously, the wine country and the hotels around the San Luis Obispo area. Big pullback in spending there. But as noted, the economy has already come roaring back. This is a look at a monthly GDP estimate. Now, you can easily, with some of the data we have, you can convert the quarterly GDP into the monthly. And it is helpful. This data takes us through July. And again, you can see February was the peak, a small decline in February, an enormous decline in April, but then May and June, an enormous bounce back. July slowed down just a little bit, but we are pretty close back. Indeed, when you think about the trends that emerged in the second quarter of the year, and of course, the beginning of the third quarter, what you quickly realize is that growth in the third quarter this year is going to be well over 30%. That's right, the 33% down is going to be followed probably somewhere on the order of a 34 to 35% increase up. Now, that doesn't bring us all the way back to normality, but it gets us pretty darn close, pretty darn quickly. And that's the important thing of all. And of course, this has been driven largely by spending. Now, I appreciate that spending, again, on hotels and restaurants, things that are so important to the tourism sector of the Central Coast, are lagging this recovery. There's no doubt about it. But people have money. They have money because the income hits haven't been as severe as you might think, given the jobs numbers. And equivalently, a lot of the federal government has been pouring money into this economy through that $3 trillion plus stimulus plan. The net result of that is consumers are bouncing back. And you can certainly see it, for example, in the auto numbers. Take a look at the right-hand side. Auto sales declined to a little under 9 million, basically where we were in the Great Recession, but they're already back above 15 million. That took 7 years during the Great Recession. It took less than 4 months this time. It tells you a lot about the underlying strength of the economy. And on the left-hand side, you can see it in terms of spending when you break down goods versus services. People can't go to restaurants. They can't go stay at their favorite hotel. They can, however, buy bikes. They can buy campers. They can buy goods. And goods spending, believe it or not, is above trend. Indeed, take a look at this data. This is retail sales through August. We just got this data. And it's amazing because the August number wasn't all that good in terms of growth, but of course it wasn't. Retail sales bounced back above trend in June. That's how rapid a return to spending occurred. Now let's be really careful about who's succeeding. On the right-hand side, top of the list, non-store retailers. In other words, retail sales are booming, but it's stuff getting shipped to our door, not stuff we're buying in stores. Well, at least not some stores. Number two, of course, is building materials. That's Home Depot and Lowe's. They're doing great. Everybody's fixing up their house. Food and beverage stores, sporting goods, hobby. You can see the big bounce. Who's lagging? Gasoline stations, because we're not driving so much, and of course, gas is cheap. Restaurants, of course, still suffering, although amazingly, spending is only down 17% from last year. That's true. Restaurant spending right now is about 83% of what it was last year. Now, restauranting is a tight margin business. A 17% decline is enormous when you think about profitability. But people are still spending money, and of course, clothing, bottom of the list. Nevertheless, despite this good news, the press continues to have to downplay everything. They talk about, oh, the slowdown in retail spending growth has occurred because of the jobless aid ending. No, it's because it's above trend. Now, again, don't expect reality when you're reading the papers today. They've drunk the Kool-Aid of a depression-type crisis, despite the fact that the data doesn't suggest anything of it. The good news, of course, is already noted. The second surge is largely behind us. The number of new cases in the United States continues to fall. That's true, of course, here in California as well. Here are some of the states on a state-by-state basis. By the way, this is the number of new cases per million people. This is Financial Times data. The most important part of this had to do with the fact that despite the second surge in the number of cases, we never saw a big pullback in consumer spending. Again, we are becoming used to living in the age of COVID. And that's one of the most important things of all. People learn, they understand the risks, they understand the returns, and they operate appropriately. One of the most amazing things about the second surge is how much of an impact it didn't have on the U.S. economy, though all you can say is it slowed down the recovery just a little bit. And you get into California, yet again, relatively good news. You can see the data on the right-hand side in terms of the number of new cases. The 14-day average has come down substantially in the San Luis Obispo region. Very, very good news. Obviously, you should be very quickly able to reopen a lot of the parts of the economy that have been closed by government mandates. And again, that's going to help those job numbers get back into place pretty quick. And indeed, if you didn't catch this, just a few days ago, our overall positivity rates of these testing has fallen to an all-time low of 3.6%. And of course, what that means is yet again, you could take a trip to New Jersey. Okay, that's probably about as exciting as going to see the Giants play, but you know what I mean. Anyway, as already noted, we have to appreciate that while the economy is rebounding, not all sectors are rebounding, of course, equally. Restaurants and hotels are still down pretty far, and transportation, that's mainly airlines, down even farther. Some of the standard tourism is just not taking place right now, and that's something to worry about. For example, take a look at hotels. You can see that on the left-hand side, up to about 45%, good strong trends from where we were back in April. However, obviously not back to where we were in February. Now, one of the things about this data that you want to keep in mind here is that it's a really bifurcated recovery. If you go to coastal hotels, you go to a place like Pismo Beach, it's doing pretty well. People are desperate to get out, and if there's a place to go, you will go there. Indeed, I think some of the hotels in the region are actually doing better than some might think. On the other hand, if you're a hotel that's attached to a convention center, if you're a hotel that's basically a business hotel, if you are a hotel that's attached to a recreation area like Disneyland, you're doing terribly. If you're a hotel that relies on people flying into the area, you're not doing very well at this point in time. So it is an interesting market out there, to say the least. Again, at some level, that gives us a lot of hope for San Luis Obispo, because it is a place that people tend to drive to rather than fly to, and that is the type of tourism that's coming back the quickest. You can already see it happening. The question, of course, is the region going to open up for it, as the case may be. Now, getting a little local into the region, we know, of course, the taxable sales are down. We don't have a lot of data. This is only the first quarter. Second quarter numbers are going to be pretty ugly, to say the least, because that was the depth of the downturn. But if you take a look at what's happening in terms of tourism, again, a bit of a bounce back. On the left-hand side is the SLO regional airport. You can see the big decline in traffic. It has come back up, still less than half of where it was in July of last year, but better numbers to say the least. And of course, on the right-hand side, you can see this is the data from like Google and the transportation data. And you can see, again, the big increase in stuff until the slowdown we saw in July and August, given, of course, the second surge in the number of cases. Good news here, you can see when we get towards the end, it's starting to pick up again. We're coming into the fourth quarter with new momentum forming. Overall, California occupancy rates, we don't have a lot of good data out there. Some of our standard sources are not publishing much right now, but the data we do have does tend to suggest the numbers are coming up. Again, bifurcated recovery, but doing a little bit better. Take, for example, 2020, if you look at in San Luis Obispo area, actually at about 60%. Not as good as the 81% you were at last year, but definitely bouncing up. And by the way, doing a little better even than, say, Monterey. That's because Monterey has a lot of convention business. Same thing with Santa Barbara, as the case may be. And certainly better than Napa Valley. So believe it or not, the numbers look pretty good. The region is in the midst of a strong recovery, but you got a ways to go. Now, one of the problems, of course, in the San Luis Obispo area is, of course, Cal Poly San Luis Obispo. As you know, a lot of the state schools are struggling to figure out how to navigate in this period of time. And the schools that have opened have had a lot of problems with emerging cases. For example, San Diego State is a bit of a problem right now. In fact, San Diego is pretty upset because it could put them off the track to reopening because of the surge in new cases wrapped around San Diego State. And of course, when we get into the local job numbers, you will see the fact that they are not really gearing up for a full run this year has caused some impact on the overall job numbers in the region, which we'll come back to. Now, getting back into what's been going out there, you think about the local retail markets. Retail is getting hit. There's no doubt about it. And it's going to be a long-term one. Not so much because of the epidemic itself, but rather because the epidemic is hastening the trend towards, if you will, people buying stuff online. Take a look at the left-hand side, the e-commerce share of retail sales. An enormous jump. And this is something that some of those core retailers in the San Luis Obispo area are going to be suffering from. But as much as that's a problem, here's a better bit of good news. Take a look on the right-hand side. When this thing first hit, we saw the sudden drop-off in sales. Inventory spiked, and of course, manufacturers simply turned off their production line. They were ready for a year-long shutdown. But then retail sales came roaring back much faster than anybody anticipated because of the preposterous, hyperbolic negative headlines. And lo and behold, they were caught unaware. Look at how the inventory to sales ratio has absolutely collapsed to the lowest we've seen in a long time. There is not enough stuff on shelves. And now, of course, manufacturing companies are rushing to pick that up. Now, this, of course, means a couple things. Production is actually bouncing back yet again relatively strongly. It's helpful for our manufacturing base, and imports are picking up. There was a collapse in imports to the ports of Los Angeles and Long Beach. Over the past 2 months, they've seen one of the biggest increases in, of course, new containers coming through as retailers and manufacturers rush to catch up with demand. This suggests, yet again, good, solid recovery fundamentals in our economy. And when you think about overall exports, yeah, they are basically down a little bit, but not as much as you might think year to date this particular year. Just down a little bit from where we were last year at this point in time. And on the left-hand side, this is some of the older crops. Obviously, wine grapes is a big one. Well, if you look at the wine data, yet again, there's good numbers there in terms of wine exports. In terms of commercial markets, because of the panic, a big pullback of permits, but overall construction has been continuing. You get into the local economy. Actually, if you look year to date, things really haven't been all that bad. For example, you look at industrial permits in the Central Coast region, actually up a little bit from last year. Of course, industrial is doing fine, largely because that local distribution has become oh so important. But overall, non-residentials has dropped just a little bit across the Central Coast because, again, of that big panic going on right now. That's more of a retail phenomenon, as the case may be. Non-residential, we have a little bit of data, and you're not seeing much of a shift in commercial market. I heard today on some news show that rents are collapsing. Commercial rents don't collapse because commercial rents are driven by long-term leases. So it takes a little while for the commercial markets to actually respond. But you do see a little bit of a softening, for example, about negative 0.4% for office space in both Santa Barbara and San Luis Obispo. Retail, well, there's been pardon me. It does look like there's been a bump in rents, although I have to figure that there's something odd about this data. I'm going to have to take a look a little deeper. I wouldn't look at it too much. The big key here, of course, is the vacancy rate for offices. I'm not sure what's going on with the retail numbers. My apologies. I'm going to have to go and get this corrected before we get these slides posted. Something very strange going on there, clearly. As for the housing market, again, the tales of doom and gloom and woe and collapse about housing has been humorous. Last time I was with you, I said there's no way housing is going to collapse with the fundamentals out there today. And lo and behold, those low interest rates and the fact the economy is doing well, existing home sales have roared back from May through June and July. The August numbers up more. Home prices in the U.S. are actually accelerating, not decelerating at this particular point in time. Overall housing permits have picked up. And as for commercial debt markets, believe it or not, we saw a decrease in delinquencies in the second quarter of the year. Turns out financial Armageddon really was simply in the minds of the billionaire hedge funds who were screaming for a handout. Getting a little closer and again into the San Luis Obispo region, you're not seeing a collapse in rents at this point in time. Indeed, they've actually come up just a little bit in terms of growth rates, so no big numbers there. And home prices, same sort of thing. Take a look at the right-hand side here. San Luis Obispo, you can see home prices, actually median prices starting to bounce up again after a little bit of weakness. Again, housing markets have a lot of strength for anything that is listed. The biggest issue out there you'll find is one of lacking inventory, multiple bids coming in, home prices coming in hot and heavy. As I've said over and over again, the biggest thing in San Luis Obispo is you need to build more housing. And that's particularly true right now, given this demand. Now, over on the right-hand side, sales did pull off in the second quarter. But again, when you start seeing the third quarter, those numbers are going to come in. We did this quarterly because the monthly numbers are bad. But again, it's going to come roaring back when we get the third quarters. Just again, remember these sales are home prices. This is through July. This is again being driven by those numbers. As for permitting itself, it has fallen. This for me, yet again, is probably the biggest problem of all. Our panic, our unnecessary panic over the short-run issues in the U.S. economy has caused us to pull back on trying to deal with the long-run problem of a lack of housing. Overall, single-family permits are down about 18% year-to-date through July, through the second quarter of the year, excuse me. As for multifamily permits, down about 5%. Again, housing is so necessary. And what I'm hoping is in the second half of the year, as particularly local developers realize that this panic is excessive, they will get back to the business of getting stuff permitted, and local governments will help them do just that. Now, the biggest lagging indicator, as in all recessions, is, of course, jobs. And there's no doubt about the fact that we are still behind. If you look at payroll jobs in the U.S., they're still a little over 10 million below where they were in February, so we're about halfway back. On the right-hand side is some of the California data through July. California is down about 9.4%. Obviously, front and center on that, yet again, leisure and hospitality, down about 30% from where it was a year ago, 600,000 jobs in that one sector alone. And then, of course, it's government. Government's number two on that particular front, retail, trade, and other services. A little closer, but when you start talking about what's happening from a labor market perspective, remember, while we're still down a lot of jobs, the unemployment rate has been falling very sharply. Now, remember, there's two kinds of unemployment. The unemployment that surged at the beginning of this were people who were on temporary layoff. They weren't truly unemployed. They just weren't able to work. They knew where their job was. That was the entire beginning surge. And then, of course, that temporary layoff unemployment rate got close to 12%, higher than it's ever before. That is now below 6%. But those who have truly lost their jobs, those people who are looking for a job and don't have one available to them, that is rising right now. And here it is over the last year or so. Yet again, you can see those trends. The discouraged workers up to about 8%, now below 6%. Temp up to 12, now below 4, believe it or not. But those who are truly out of work, That's gone up to a little above 4%. Now, when you think about this number, a little above 4%, the tech recession, which was one of the most mild recessions we've seen in the US in the last 40 years, you saw that number of people who truly didn't have a job option in front of them get up to about 5.5%. So actually, when you think about the number of people who are truly dislocated through this business cycle, it turns out the numbers are still very low. If you push aside the crazy up and down and the short run reaction, what you see is this is actually a mild recession, and mild recessions have relatively quick recovery. Now, you've heard a lot about the K-shaped recovery. That is to say, some folks are doing better and some folks are doing worse. That is absolutely the case. Remember, you think about the rest of the parts of the economy that are closed down right now: theme parks, hotels, restaurants. These sectors, of course, hire a lot of lower skilled folks. And you can certainly see, say, for example, the unemployment rate for people without a high school degree, that went way up to 22%. It has fallen quite a bit. It's fallen by almost half. Whereas for people with a bachelor degree or more, that got up quite high as well, but is already substantially down as well. And you can see wage growth by occupation on the right-hand side: high skilled, low skilled, mid skilled. For high skilled and mid skilled jobs, wage growth is about the same as it's been. But there has been weakening in low skilled, again, because of the phenomenal job loss in these type of sectors. Unemployment in California, again, the temporary share has been falling, but it's still about half. It's a big number. As much as unemployment rates here are high, the numbers have come down. As for small business itself, well, yet again, here's some of the best news I can give you. It's amazing to me how we continue to talk about small business suffering. There's no doubt that some small businesses are going to close right now. In a lot of cases, they're going to close because it makes strategic sense. Look, if you're a small restaurant and you haven't been able to make a lot of money for 6 months, and you're at 6 months of rent to pay, you may very well be better off simply closing that restaurant. Now, does that mean you're not going to run a restaurant? No, you are. You're just going to go find someplace else to run a restaurant, because when the virus goes away, when restaurants are allowed to fully reopen, we know there's going to be a lot of demand for restaurants because of all that dry powder out here. And guess what? There's been an enormous surge in applications to start new businesses. That purple line, by the way, this is high propensity business applications through August of this year. High propensity, by the way, that means that the people who are applying are giving data that suggests this is the real deal. They're talking about wages. They're talking about the number of employees. They've told what sector they're in. And look how high it is. It's the highest it's been in really over 15 years. These are great numbers, and again suggest that while some small businesses are going to close, a lot of new small businesses are going to reopen in their place. You already see the seeds of a big bounce back. Now, again, let's get into that Central Coast region and talk about what's going on. Well, the unemployment rate in San Luis Obispo, at least as of July, dropped down to a little bit above 8%. Relatively good numbers there. By the way, this is seasonally adjusted number, which is important because I'm going to show you something just in a second. On the right-hand side, you can see overall, again, data, and I'm kind of linking this up. And yes, when you look at job losses through July, San Luis Obispo and Santa Cruz are near the bottom at 13 and negative 14% from where jobs were last year. The area has been hit harder than most. When you think about the importance of tourism, this isn't much of a surprise. And remember, July was, of course, the peak of the second surge in the number of new cases out there. Now, before you get too worried about that, let's dig into the data a little bit quicker. Let's remember that the economy had been doing great up prior to this, about 3% growth in the 1920 era. So jobs really are coming back very strongly. Construction up there, professional business services, healthcare, hospitality was doing very well. So the area had a lot of good trends. Now, when you come into what happened through July, again, a big drop off in jobs, coming back relatively slowly through July. Overall percentage down about 13.5%. Well, here's the most exciting stuff I can give you. We have the August numbers as of this morning. And while I was sitting here waiting to get online, I managed to process those new numbers for you. Now, this isn't seasonally adjusted, so they don't match up perfectly with the numbers I gave you. But you can see the unemployment rate has indeed come down. At this point in time, it's actually 7.8%. So that's a very, very good drop in the overall economy, considering where it had been prior to that. Very, very good numbers, well below 10%. And of course, if you talk about where things are down, well, remember, leisure hospitality still lagging. But, you know, it was 30% down in July. Now it's about 27% down. You could see it coming back relatively nicely. Overall jobs are down 14.5% year over year. Last month, now they're down about 12.3%. So August has seen a pretty strong bounce back in the overall number of jobs in the region. The second worst sector, of course, is government. And the government numbers in August are driven by the fact that local schools and, of course, that university, Cal Poly San Luis Obispo, that great local university, simply weren't doing the standard hiring they do at the start of the school year to bring people in to get ready for a whole bunch of new students showing up. A lot of those students aren't showing up. They're taking their classes remotely. And as a result of that, that sector is lagging as well. But other parts of the economy definitely are bouncing back nicely at this particular point in time. Again, good, steady numbers. Recovery is here. Got a ways to go. Labor markets do lag everything else, but you can already see things bouncing back nicely. Now, this is, again, through July of this year. Take a look, for example, leisure and hospitality employment. You can see the bounce up through June, and then, of course, flattening out in July with the second surge. As noted, August numbers are a little bit better. Manufacturing has been particularly hard hit in the region. And this is something I'm still trying to puzzle out just a little bit. I'm not sure what it is about local manufacturing that would have made it hit so hard. Hard to say at this particular point in time. That has not happened. It's one of the reasons why the area seems a little bit worse. This one we need to break into a little bit more. The problem, of course, is the data we get in the short run for San Luis Obispo isn't very in-depth because of the nature of the CES survey. The data we really need to look at is the QCEW, the quarterly census of employment and wages, and we won't get second and third quarter numbers until December and March. Accordingly, that data is just lagged. So when I'm with you next time, hopefully I'll have a little bit more to unpack on this front, but it's hard to get into exactly what's going on in manufacturing. But I would note it's a concern that should be thought about for local development professionals. As for construction itself, yet again, down a little bit more relative to the state overall. Again, why hasn't it bounced back clearly? That's a little bit hard to say. We don't have the underlying numbers, maybe because perhaps because of the phenomenal pullback in overall permits. But again, with stronger numbers in the months ahead, I'm hopeful, of course, that these numbers will come back and help the recovery at all. On the other side of the equation, where California agriculture has been hit, agriculture, of course, in the San Luis Obispo region has been just fine. Those numbers have been nice and strong, above, a little bit above where they were last year at this particular point in time. A lot of that, of course, has to do with the nature of the kind of crops that are grown there. Of course, when you're stuck at home, a lot of people like to drink good wine. Now, getting into a little bit looking ahead, remember we talked about the dry powder that's in place. Yes, the recovery is stalling just a little bit at this particular point in time. However, the dry powder, the $3 trillion stimulus plan that was put into place. It's amazing, but how dramatic the numbers have been. Yes, personal income has dropped by a little less than $1 trillion from February to July of this year. However, for every dollar of lost personal income, the federal government has put back about $2. The net result of that is, oddly enough, in the midst of this very deep, although short recession, incomes have actually been rising. Now, of course, the big issue there is that people can't spend money. They're not allowed to because restaurants are closed, Disneyland's closed. So where are they putting that money? Into savings. And the numbers here have been just phenomenal. Take a look at the left-hand side. This is commercial bank deposits, up well over $2 trillion. That's like 16% in just about 6 months. And on the right-hand side, you can see the savings that households are tucking away. This is straight out of the personal income savings numbers. Over the course of 5 months, they've saved up, probably about $1.3 to $1.4 trillion. Actually, a little higher, about $1.6 trillion. Plenty of money out there that will be spent, that will get this economy rocking and rolling. And you want San Luis Obispo to be there when this money comes out. The key to getting this money released is getting control over the virus. No more, no less. Get full control over this virus, and this money will get things going. From my perspective, I'm not worried about the short run. This recession will be largely erased by the middle of next year. This is going to be ancient history very, very quickly. What are we going to be left with? Two major things. First, phenomenal government debt. The federal government's lining up to borrow $3.5 trillion. In June this year alone, they borrowed more money than they did in all of 2019. The numbers are truly staggering. Why is nobody paying attention to this? Well, for the most part, money's getting poured into the banks. And of course, those banks are turning around and using those new deposits to buy treasuries. So it doesn't matter. It's kind of cyclical. So, but what happens when people start to spend that money? Well, now, of course, there isn't all this excessive bank deposits. Now there's not excessive demand for treasuries, but the government still has to go sell lots of treasuries. What happens then? Well, when there's not a lot of supply and there's a lot of demand, we call that a hike in prices. And yeah, that means higher interest rates. One of the things we're looking for that should worry everybody in 2021 is what happened if interest rates start to go up. And remember just how spectacular $3 to $3.5 trillion of borrowing is. In 2019, the entire nation borrowed a total of $3 trillion. And that's everybody, private and public, federal and state, $3 trillion. This year alone, federal government's got to borrow $3.5 trillion. That's going to upset those markets. And of course, there's the Federal Reserve. The Federal Reserve is operating like this is the Great Recession, that there is a collapse in wealth and that there's a desperate decrease in money supply that they have to offset to prevent deflation. But guess what? The money supply hasn't collapsed. There isn't a collapse in wealth. Price growth is actually starting to increase again. And of course, the stock market has come roaring back. Home prices are up again. What collapse in wealth? The net result of this, of course, is the Fed has exploded their balance sheet. And unlike the Great Recession, where the explosion in balance sheet simply kept the money supply constant, this time the explosion in the balance sheet has caused money supply to absolutely explode to almost 25% growth on a year-over-year basis. If you're looking at this and you're thinking, doesn't this look inflationary? Bingo, inflationary. Now, mind you, it's a couple of years for inflation to really kick in. And of course, it depends on the virus getting under control and all that money coming out of checking accounts. But the recipe is being followed, and unless the Federal Reserve changes course rapidly, we really could be in for a strong bout of inflation looking ahead a couple of years. So higher interest rates, higher inflation. If you stay looking at this and going, boy, it sounds like the late 70s, that's what I'm thinking as well. And what scares me more when it comes to the late 70s is when the Federal Reserve announces that they're okay with a little bit of inflation. No, they shouldn't be. They really need to be backing off. Monetary and fiscal policy has been overwhelming. They need to take a step back before they do more harm than good. Unfortunately, the conversation at the press level, because of the hyperbolic panic, is borrow more, spend more, lend more. Not good. I am worried about this for all the different reasons. So I went through that. Last time I remember talking too long. This time, looks like I'm going to talk a little bit too short. But with that in mind, let's go ahead and dive right into it. Remember, the V is the only logical outcome. The speed of recovery is dictated on the speed of getting control of this virus. By the way, I need to change one thing. Well, I forgot to update the slide. But to be clear, our baseline forecast, we have upped our Q3 number from 26 to 34%. And depending on the September numbers, it may even be higher than that. Unemployment is dropping. It's going to be well below 7%. Again, some sectors are going to lag. Retail, restaurants, tourism, particularly global tourism, are going to lag. Yes, that's going to be a little bit tough for the San Luis Obispo economy. You're going to be lagging a little bit behind. But remember, you're lagging behind a fast recovery. You're not lagging behind a slow recovery. There are wild cards to worry about. The global situation is still a problem. Government budgets, inflation, higher interest rates. Will there be a true second round? I don't think so, but we'll see. But ultimately, our true enemy, the worst enemy of all, is miserableism. This incessant need to make everything worse than it actually is. Bad policy being driven by a basic lack of context. The fact that basic health needs has been conflated with culture wars. Folks, this isn't complicated. We don't need massive government mandates to shut down the economy. You know what we need to do? We need to wear our damn masks. Simple as that. Wear your masks. And I tell you what, the most frustrating part was this was a moment, this was an opportunity for our nation to pull together, to work together to get control of this virus. And instead, the inherent divisions among us have simply driven even this opportunity to come together and made our overall political divisions worse. To me, it's a sad testimony to the state of politics in this nation. We need to get over that. We need to move on. But in the meantime, I will tell you this. I get it. It's rough. It's scary. It's odd, but it's quick. San Luis Obispo is going to come roaring back. Don't forget the long run. Wear your mask, get control of this virus, and be healthy.
We'll conclude there.
All right.
So much. I do want to just take a moment to again thank our sponsors. I want to thank you all on the other line here for joining us today and for bearing with us with some of the technology issues.
That's okay. It happens.
Indeed. Keep an eye out for the link to the recording of the presentation. Hopefully we can cut some of that out. And I want to remind everyone, November 18th, 9 o'clock, mark your calendars. This is the big annual event. We are going to build on today's presentation with more economic analysis at the local, state, and national levels. Sponsorships are still available, and sponsorships get you tickets. We are selling tickets as well, and you should see that hit your inbox towards the end of October. You are not going to want to miss the November.
And the lead sponsor gets to go on a wine tasting trip with me. How's that?
Oh, there you go. There you go. That's a big incentive.
I'll pay.
I was going to say, do they have to buy? Because that might actually. All right. Well, thank you, Chris. And thank you to everyone for joining us. We'll see you on November 18th.